Hey guys, it's Tyler here from Macro Ops, and today on the Fallible channel, I'm going to go over an interesting Graham Stephan video that I saw. I know some of you guys probably watch him and you're fans. I'm a fan too. I really like the guy. And he's talking about how to invest in the stock market. So I'm going to watch that video and I'm going to kind of commentate it and give my 2 cents on what it coming from the market as an expert. But before I do that, make sure to hit that subscribe button and smash that like button, and also leave a comment below and tell me exactly what you guys want to see in this channel. We have a ton of different content planned, but I want to do exactly what you guys want to see. Do you want to see trade replays? Do you want to see more reaction videos? Do you guys want to see more tutorials on options or futures or other types of derivatives? Leave it in the comments below, let me know, and we'll make it for you guys. All right, now let's get into it. So here's the video in question from Graham Stephan, and it's how to beat the stock market in 2019, and it has 209,000 views, so it's a very well received video, 23K likes. And obviously we have a couple opinions on how to beat the stock market, so let's watch and we'll see what he says and if I agree with it or disagree.
First of all, let's get this out of the way. I think it's really important that none of us fear a recession or think that the stock market dropping in price is necessarily a bad thing. Instead, I think it's so important to embrace this mentality whenever it does happen. There's a saying out there that goes something like this, that riches are made in recessions, and I have to say that could not be more true. Like anytime the market drops in price, that just becomes an unbelievable opportunity to buy low and make money.
All right, yeah, I gotta believe, I definitely agree with that sentiment there. When the prices fall and the stock market gets super low, that's when the true 2x, 3x, 4x gainers can happen. Like in '08 when guys went in and bought like Bank of America at $2, or all these banks or casinos down in the basement, and they 10x their money. So recessions are, if you have dry powder and you actually have cash to invest when they hit, they can be some of the most lucrative times. And I believe Graham made a lot of money in real estate by buying once the housing market collapsed in 2008. And so you'll see a lot of these guys like Graham and other successful people, traders, investors, real estate investors, business owners, guys that went in big when everyone was freaking out and scared, actually end up doing the best. So I definitely agree with that sentiment. So let's see what he says on that.
Arguably, one of the biggest reasons why I did so well in real estate was because I got in as soon as prices started going downhill, as soon as prices started dropping, and as soon as things started getting really bad. As soon as people were getting out of the business, as soon as people were selling properties left and right, and as soon as prices began plummeting, is when I started buying in because there was money to be made. So from this perspective, we should absolutely view a price drop as an opportunity, not as this gut-wrenching feeling that your investment is losing its value. And that will be a very tough reality that many investors will have to face. Especially if you're someone who's only been investing for the last 5 to 7 years, all you've really been accustomed to is the market continually hitting all-time highs and consistently getting these 5 to 20% returns each and every year.
Yeah, so that's definitely not going to happen each and every year. So if the S&P averages say 5 to 6%, maybe upwards to 7 to 8% over the long term, it doesn't actually just get you 7% per year. It looks like up 20, up 15, down 10, up 3, up 4, down 30%. And all those oscillations around that 7% growth is what's called volatility. And that's just the reality of investing in the stock market. So you can't get away from that. Everyone has to stomach it. And that's why we talk about so much about psychology on the channels, because in order to be successful in investing, you have to have the right psychological mindset to actually withstand those swings.
Is not normal to happen consistently, and there will be years that you will end up losing money and have to plan accordingly if you want to come out ahead. Because here's the thing, when the stock market does go down in value, statistically the best thing you could possibly do is to smash that like button if you haven't done that already. Just kidding. The real answer when it comes to this is that the best thing to do is absolutely nothing. That's right, it's to do nothing. Studies have shown that market timing rarely ever works consistently, and that it's nearly impossible to predict when the market is going to drop in value and when it's going to skyrocket back up in value.
Okay, yeah, so I mostly agree with that sentiment, and for most people this is true. You can't really predict the market, especially if you're kind of playing around. It's a hobby thing. There's guys that can do it. We know the legends, PTJ, Stan Druckenmiller, Warren Buffett, many legendary investors and traders out there. But those guys do this thing all day, every day for 8 hours a day. And that's why, or even more than 8 hours a day, and that's why they're able to do it. But your average guy, who's working their day job and on the sides, trying to play around with 20, 30K or whatever that may be, that's definitely not going to work for that person, trying to time the market and think they can actually get it correctly. So that's why when we see all these studies that he's talking about saying that, hey, you should just not try to time the market, put it in there. It actually is good advice, because for someone who's kind of doing this as a passive side thing, that's generally what they should do. But guys that want to be more active and really go all in and put significant time and energy into it, it is possible to time the market and actually make returns better than buy and hold. But anyway, let's go see what the rest of he has to say about that.
Some people might get lucky with timing the market here and there, but being able to do this long term, accurately, and consistently is pretty much not going to happen. And like I said, this is not just something that's in my opinion. This is something that's been studied very thoroughly. For example, the investing firm Charles Schwab. It's so hard for me to say Charles Schwab, by the way. You say that like 5 times and you can no longer say it anymore. Charles Schwab. Charles Schwab. It's hard to say. Anyway, you know what I'm talking about here. They analyzed the investing data between 5 different groups of investors between 1993 and 2012, and this is what they found. The first type of investor invested $2,000 at the absolute lowest price point of each and every year. The second investor just invested $2,000 at the very beginning of each and every year. The third investor just invested an equal portion of the $2,000 each and every month throughout the entire year. The fourth investor invested $2,000 at the absolute highest price of each and every year, and the fifth investor just didn't do anything and kept the money in cash, just waiting for a market crash. Now, it was found that obviously the best investor from the entire group was the one that invested each and every year at the lowest possible price, and at the end of those 20 years had a total investment of $87,004. But now the surprising result when it came to this was that the second investor, the one who invested $2,000 each and every year, just at the very beginning, had a total investment return of $81,560. That's only $5,300 less than the investor who had literally perfect timing each and every year, down to the exact day for 20 years. Then, of course, we have the third investor who just invested an equal portion of that $2,000 each and every month, who didn't come too far off, with a total investment return of $79,510. And even the fourth investor, who had the worst possible timing, who put in their money each and every year at the absolute market peak, had a total investment return of $72,487. And then, of course, our cash investor, who was waiting for the market to crash, had the lowest overall return, with a total investment value of $51,291. So I think this is pretty clear. Even if you have perfect market timing, down to the exact price, down to the exact day and exact hour, over 20 years, you're only going to come out ahead an extra 6.8%, opposed to the person who just invests the money immediately from the very beginning.
Okay, so this is actually a really important point. I think it's a great point. And I want to bring out the whiteboard here to kind of show you guys why this is the case. Let me get rid of these scribbles here. So the reason that time in the market is more important than time in the market over the long term is because that 6 or 7%, that's a long-term growth rate, and you're going to get that the longer you stay in. So if you're only in for 1 year, you could earn anything. You could earn 50%, you could earn negative 10%. But if you're truly committing long-term money, no matter what time you put it into the market, and you're willing to hold that for 20 years, it's just going to converge around 70% or 7%. So if we look at, let's say, a graph, and this would be a 0% return. Let's put, 50 here, 10 here, and then let's put negative 10 here. And then here would be the x-axis with years 1, 2, 3, 4, 5, 6, etc. When we start off, and in year 1, we have no idea if it's going to be up 50% year, or if it's going to be a down 10% year, or whatnot. But over time, this volatility starts to dampen, and we converge on that long-term growth rate of 7%. Now let me draw a little better picture for you. So think of it like this. The stock market over time is growing people's wealth like this, and that's because of 2 things. Number 1 is inflation, which is about 2% a year, or sometimes more depending on the macroeconomic environment. And then on top of that, we have growth, which is essentially productivity gains that we get as an economy from companies solving problems and us getting better producing goods. And so this is what causes wealth to grow over time. And all of those up 30%, down 10% years, that's essentially just volatility and traders reacting to news, and all that stuff just washes out at the end of the day. So if here's the growth rate, and we can picture each year, the market is sort of moving like this on that growth rate. Now, what that Charles Schwab study is saying is it doesn't really matter if you buy here, or if you buy here, or if you buy here, or if you buy here, because over the long run, that's all going to average out, and you're really just going to end up on this curve, and you're going to get that long-term 7 or 8%. And so that's why time in the market is super important, and we saw that even the guy that, here, let me draw the graph again, and here's the volatility around it. Even the guy that perfectly timed the market right back over here at the beginning near year one, versus the guy that bought at the top, you know, that difference right there for that particular year, it doesn't really compare to the vast amount of change that the stock market would grow over the 20 years. So you're basically, when you're trying to time the market in a single year, you're kind of nickel and diming when this thing is going to, you know, 3x, 4x, 5x over the 20 years, and you're trying to nickel and dime a little bit of a price point. It's really just not going to matter over the long term. So I think that's actually great advice for Graham to pull that study up, look at Charles Schwab. They show, hey, it doesn't really matter what you do. If you're buying low, if you're buying high, if you're buying, you know, at the worst time or the best time, it just matters that you're in the market. And that's because for number one, you're earning the inflation rate. Number two, you're earning the growth rate. And everyone gets to realize that same number over the long term. So there's really no need to worry about all the tiny little fluctuations. All right, let's get back to this video.
And the chances of you being able to do that consistently down to the day, every single year, over 20 years, statistically, it's just not going to happen. And if you're not quite convinced on this, Charles Schwab, I still can't pronounce that, Charles Schwab analyzed 68 rolling 20-year time periods dating all the way back to 1926. And they found that in 58 of the 68 time periods that were analyzed, that the results were exactly the same.
Okay, so that just, I mean, proves the point further. You look back in history, it really doesn't matter, right? You could try to market time over any little period in time, and as long as you're consistently contributing into the market, it doesn't really matter, because we're not talking about you have 10 million bucks and you put it all at once and then watch it go. That's not what happens to the average investor, right? The average investor, we're slowly putting 2K away, 2K away, 2K away, 4K away, you know, 10K contribution to the 401k, 10K contribution to the IRA. And so because there's such small amounts and we're doing it slowly over years and months, the actual time in which you buy doesn't have a big impact on the end event. And like I said, it all just converges to that long-term growth rate anyway. So worrying about, you know, micro worrying about the 2K, if you should put it in now or later, it's just a complete waste of brain power. And really the only people that should be thinking about that are, you know, people that have some huge massive inheritance, like 10 million bucks or 5 million bucks. And you're like, okay, now what do I do? Where do I put this money? And obviously, you know, choosing that type of commitment is a lot different than, you know, where you should put your 10K in your 401k, right? And it's just not that big of a deal. And this study, and Graham shows that, actually it proves that point.
Timing in the stock market always will come in first, but investing your money immediately as soon as you possibly can always tends to come in a very close second. Dollar cost averaging then came in a very close third, and then so on. And if you still don't believe me, the study also shows that investing your money immediately never came in last place in terms of your overall investment return when you look over a 20-year time period.
All right, so he's basically proving the point here that it's all about time in. And that's because if we think about the stock market as a long-term savings account that earns 8% instead of 2 or whatever the heck they give you nowadays in a checking account or savings account, essentially what you're doing is, by not putting that money in, you're losing out on that 6-7% annualized every single month you wait. And remember, over time, it does average out to that point. So you'll have a 6% or 6 to 7% growth rate over time. And this account is continuously compounding at 6 to 7%. And so if you get some money on January and you get scared because you're reading Zero Hedge, you're worried about what's going to happen in the economy, and you don't put it in until July, you actually lose out on that compounding that could have happened between January and July. And remember, that's over the long term. So it's hard to see, though, because the market's going to be going like this in between that time period. You know, and you might put it in here and it'll go down. You think it's a bad investment and pop back up again. But that's not how you think about investing for the long haul, and that's not how most people are doing it. And you just got to constantly think about the stock market as a savings account that's earning 7% a year over time. As long as you don't touch it, as long as you don't screw with it, and it's all the money that you commit to it is for the long haul.
See that it's more important to invest consistently and not sell than it is to try to time the market perfectly every single year over 20 years.
Okay, so I mean, I basically agree with his sentiment here. I think what he's saying is the correct thing. and makes a lot of sense to me, guys. So let me know what you think down in the comments. Do you like this approach? Do you think it makes sense? You know, are you questioning like the way I'm looking at it? Leave it down in the comments. I'll get back to you guys. And finally, thanks for watching this video. We appreciate it. Make sure to hit that subscribe button and the like button. And again, also tell us what stuff you want to see, and we'll bring that to you as soon as possible. Everyone have a nice day. I'll talk to you soon.